Hello and welcome to our webcast. I'm Amy Pendergrass with Moss Adams and I'm going to get us started for today's session, Not-for-Profit Tax Update for Fall 2020. Before we begin, I'm going to play a brief video.
Welcome and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
And now I would like to turn it over to one of today's presenters, Jane Coleman, Senior Manager at Moss Adams. Jane?
Great. Thanks so much, Amy. So good morning, everyone. Today we'll be talking about a lot of topics today. We'll be talking about the final regulations that were issued recently under Section 512A6 related to the reporting of separate unrelated business income activities, and the other under Section 4968, which is related to the endowment tax for certain colleges and universities that they must pay on their net investment income. And we'll also be talking about other tax legislation updates, both COVID-19 related and non-COVID-19 related. So as you may know, as part of the Tax Cuts and Jobs Act, Section 512A6 was added, and it requires that unrelated business income, otherwise known as UBI, be computed separately by exempt organizations that have more than 1 UBI activity. So beginning January 1st, 2018, exempt organizations were no longer allowed to use losses from one activity to offset income from another activity. So this concept is commonly referred to as UBI siloing because each UBI activity needs to be in its own silo. So proposed regs were issued in April 2020, and final regs were issued last month. The IRS did not provide for any de minimis exception to implementing this. So meaning no matter how big or small the exempt organization is, it has to follow UBI silo rules under 512A6. So how do we identify UBI activities? Well, the regs say that you should use the first 2 digits of the North American Industry Classification System, otherwise known as the NICS coding system, which can be found on the NICS website. and it covers about 20 business sectors. The final regs clarify that the determination of which two-digit code to use is based on the more specific NICS code, such as the 6-digit level that describes the activity. So you'll want to report the two-digit code, each two-digit code only one time, and you can combine the same activity that operates in different locations. For example, let's say you have a hospital system that operates facilities in several locations, all of which have pharmacies that sell goods to the general public. All the pharmacies would be reported on the code for retail trade, even though the pharmacies operate in different locations. Also, the two-digit code chosen must identify the UBI activity, not the exempt activities. So, for example, a college or university cannot use the code for educational services to identify its UBI activity. And also, if the UBI is from a sale of products in a store and online, so for example, a college bookstore, the in-store sales determine the NICS code for both online and in-store. And once an unrelated business has been identified with the two-digit code, the code cannot be changed unless the organization can show that the original code was selected because of an unintentional error, or that another code more accurately describes the business. The final regs also clarified how the UBI silo rules affect the public support test. And it said that you're allowed to use either or. So you can either use the unrelated business taxable income calculated under the silo rules, or you can use the unrelated business taxable income calculated in the aggregate, so under the old rules, where you can net losses against income. So this is great news because the IRS was trying to prevent the silo rules from having a negative impact on your public support test. And the IRS was also trying to reduce the administrative burden of requiring two separate calculations of unrelated business taxable income. So here we've listed the 22-digit NICS codes on this slide for your reference, which can be found in the NICS manual on their website. The IRS still did not fully address the issue of expense allocations in the final regs, unfortunately, but they do plan on issuing separate regulations on this in the future, so more to come on that. In the meantime, the regs did incorporate the existing allocation standard, which says that an organization must allocate reductions on a reasonable basis between separate unrelated business activities. The regs also said that the unadjusted gross-to-gross method in general is not a reasonable way to allocate expenses unless the amount charged is the same for related and unrelated services or products. The final regs also clarified that charitable contributions can be taken on the 980 and that it's applied after UBI siloing are calculated. So you don't have to calculate a charitable contribution deduction separately for each UBI activity. And when it comes to net operating losses, the UBI silo rules require that you determine any NOL separately for each activity. These are called the post-2017 NOLs in the regs. And it can only be used against that UBI activity going forward. So essentially, those NOLs are trapped in each silo. But the NOLs generated before 2018, referred to as pre-2018 NOLs, however, can be taken against total unrelated business taxable income. So the pre-2018 NOLs are deducted first from total unrelated business taxable income before deducting any of the post-2017 NOLs that are trapped in the silos. The IRS recently released drafts of the 2020 Form 980 and a new Schedule A that goes with it. And here are the links to it if you're interested. But it's been redesigned a bit to reflect the implementation of UBI silo rules. So this new Schedule A for the 2020 Form AT appears to be a replacement for the Schedule M that we were dealing with before. One of the major changes so far is that on the draft 2020 Form AT, it highlights on the first page summary level information, and then each UBI activity is reported on its own separate Schedule A, whereas before, for 2019, for example, the first UBI activity was reported on the first page of the Form AT, and then any additional UBI activities were reported on its own Schedule M. So it's pretty different. Also on this slide, I just wanted to show a mathematical visual example of how the UBI silo flows on the Form AT. So essentially here we have 3 UBI activities. 2 of them resulted in net income, and the third activity resulted in net loss. And under the silo rules, we are not allowed to net the loss from the third activity with the net income from the first 2 activities. So we're left with total UBI income of $150,000, which then we can take the charitable deduction against because it comes after UBI siloing, and the $50,000 loss from the third activity is trapped in its own silo and can be carried forward. So when it comes to figuring out how to silo your investment activities, the aggregation rules still apply, where you can treat your investment activities as one silo if it's either a qualifying partnership interest, otherwise known as QPI, qualifying S corporation interest, and debt finance income. So in general, the investment silo rules stayed largely the same as the proposed regs, but it did have a few clarifications and changes. One change was that the control test to determine QPIs is now called the significant participation test. Also, the 4 factors from the proposed regs to determine significant participation is now an exclusive list. So there's no more of the facts and circumstances piece. Also, the final regs clarified that debt finance income is included in the investment silo if the UBI is from directly held assets or indirectly through a partnership. And the final regs also expanded the look-through rule to permit an indirect interest in a lower-tier partnership that meets the de minimis test to be treated as a QPI, even if the exempt organization significantly participates in the directly held upper-tier partnership. I'll explain a little bit of that later on. But in order for a partnership to be treated as QPI, the regs say that you either need to meet the de minimis test or the significant participation test or this look-through test. The de minimis test is met if you hold no more than 2% of the profits interest and no more than 2% of the capital interest, and the organization cannot be a general partner. The significant participation test is met if no more than 20% of the capital interest is held in a partnership, and the exempt organization does not significantly participate in the partnership, and the organization is not a general partner. So when looking at these ownership percentages, you do not need to combine the interests owned by disqualified persons, so your board members, officers, substantial donors, and their family members, which is a great relief. For the look-through test, this is where you have an organization that holds more than 20% capital interest in the partnership, and that directly owned partnership then holds interests in other partnerships. So if the organization, if these indirectly held partnerships meet the de minimis test, then all of it can be in one silo. So here is an example of what I was trying to explain. So this is an example of a look-through test. So here, the organization holds a 50% capital interest in a partnership LP, and then that LP would be in its own silo because it's not a QPI, because it doesn't meet the de minimis test or the significant participation test. But that LP then holds a 4% capital and profits interest in partnership A, and then a 10% capital and profits interest in partnership B. Partnership A would be a QPI and it could be in the same silo as partnership LP because the organization indirectly holds 2% of the capital interest and profits interest of partnership A, because 4% times 50% is 2%. However, partnership B would not be a QPI. It would need to be in its own silo because the organization indirectly holds 5% of the capital and profits interest if you take 50% times 10%. So this analysis where you go a step further and look at each underlying UBI activity that flows through is called the look-through test. There is a transition rule available which says that if an organization acquired an interest in a partnership before August 21st, 2018, and it is not a QPI, then you may treat that partnership and all of the underlying partnerships held indirectly as one QPI. So in other words, for investments held as of August 21st, 2018, you don't have to look through to see if there are multiple trades or businesses. When it comes to S corporation interests, you may aggregate your S corporation interests with your other QPIs if it also meets the same de minimis and significant participation test. So otherwise, it would be a separate UBI activity. For S corporations, you don't have to do the look-through test, and income and loss from a K1 and gain and loss on disposition of that S corp can be treated as one UBI activity. Which takes us to our first polling question.
All right. Thanks, Jane. So our first polling question is, how excited are you that you no longer need to ask disqualified persons about their investments? A, I'm ecstatic. B, that's nice. C, wait, I was supposed to do that. Or D, didn't apply. And we'll give you a few moments to respond. To participate, please click the button next to the answer you choose and hit submit. Also, I would like to take this time to remind you to submit your questions for the presenters in the Q&A window. If we don't have time to respond during the webcast, we will do our best to follow up with you afterwards. And it looks like almost everyone has responded. All right, here are the results.
Okay, great. So it looks like it's split between A, B, and D. So that's good. I think I answered A. I'm ecstatic about that. Okay, so moving on to Section 4968, the Endowment Tax, that was also enacted as part of the Tax Cuts and Jobs Act. Friendly reminder, this is the one that imposed the excise tax of the 1.4% on net investment income for certain private colleges and universities. So you'd be subject to this if you had at least 500 tuition-paying students and your endowment was at least $500 per student. So the final regs were issued in September of 2020, and one of the changes that it contained was changing the definition of what a student is for this purpose. In the proposed regs, a student was defined as a person enrolled in a degree, certification, or other program leading to a recognized educational credential. While some commentators suggested that this definition should include all students attending the institution, even if they are not enrolled in a credential program. So the IRS acknowledged that some students may be attending in college to improve job skills or for personal enrichment. So they changed the definition of a student in the final regs to say that a student is a person who is enrolled and attending a course for academic credit and who is being charged tuition. As far as what is considered tuition paying, it excludes grants from government and the institution, but not from private parties. Also, when you calculate this excise tax, you have to take into account the assets and net investment income of your related organizations as well. And there were a lot of comments about, well, classifying some of these organizations, especially if they're taxable entities, as related organizations could generally result in taxable, in double taxable a scenario. So the final regs state that certain organizations are not related for this purpose, including a taxable corporation, a partnership, and an S corporation. The final regs also simplified the way to determine capital gains to include from partnerships when you're calculating the excise tax. So net investment income for this purpose is determined under rules similar to private foundations. But the final regs did provide some differences when calculating gross investment income. So, for example, interest income from student loans and rental income from housing provided to students, faculty, and staff are excluded from gross investment income when calculating this excise tax. Also excluded are royalty income from patents, copyrights, and other intellectual and intangible property developed from the work of students or faculty in their capacities with the school. But rental income from trademarks on the institution's logo or name or from intellectual property donated or sold to the organization is still included. So you have to make that distinction there. The gain from the sale of exchange of exempt use property is excluded from capital gain net income for the portion of the property used for the exempt purpose. And this is a big one. If capital losses exceed capital gains, those capital losses may be carried forward and deducted from capital gains in the future year. So this is a big departure from the proposed regs, as well as the private foundation rules. And lastly, you can exclude capital gain attributable to appreciation of donated property that occurred prior to donation. So other tax updates, the transportation UBI tax was repealed, yay, and it was retroactive. So organizations can file amended Form 980s to claim refunds or credit of the related taxes that were paid. The latest IRS update on this is that the amended returns are being worked on based on a priority basis. Unfortunately, at this point, there's no email or fax number to check for status of processing, and but you can call the exempt organization IRS hotline and check on status, but they may not have information at this time if the paper return wasn't processed yet. And then in general, just the IRS has been extremely backed up due to COVID and are still dealing with correspondence received in March of 2020. This Relief Act of 2019 also removed AGI limits for cash gifts made to a public charity supporting disaster relief, but the donations had to be made between January 1st, 2018 and February 18th, 2020, and you have to file an election. So now for our second polling question.
All right, our second question is, have you amended your 990T to claim a refund for the repeal of the Qualified Transportation Fringe Benefit? A, yes, B, no, C, should I, or D, not applicable? And as a reminder, if you want to would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. We'll keep this up here for another moment to make sure everyone that needs CPE has a chance to respond. Okay, here are the results.
Okay, nice. Yeah, I know we've been filing a lot of amended IATs for our clients that that needed to file them, and we haven't really heard anything back yet, either from the IRS. Okay, so one of the IRS's goals is to modernize its technology. So they're requiring that all forms 9990s and 9980PFs be e-filed, effective for tax years after July 2nd, 2019. Before this new law, the e-filing requirement was only mandatory for large organizations with total assets of $10 million or more, or for those who filed at least 250 returns. There were limited exceptions where you can still paper file the 990 and 990PF. For example, if you had a name change or for short year and short period returns that were not marked final, and for returns for those that are not recognized as exempt yet. Although the IRS is hoping to get these application pending organizations e-filed as well for 2020. They're also trying to get the 980T to be e-filed for 2020 as well as the EZ, but the EZs might take a little bit longer. And the 1023 is also required to be e-filed now, and or filed online rather on their pay.gov website. The 600 user fee did not change, but now you have to pay the fee through their pay.gov website when you submit the form online. So for private foundations, beginning after December 20th, 2019, the excise tax for net investment income is a flat rate of 1.39%, whereas before the tax rate depended on whether you met your qualifying distributions. So it was either 1% or 2%, but now it's 1.39%. Also, contributions to an IRA for individuals that are older than 70 and a half years of age are disallowed to be rolled to a charity. Donor advised funds have become an increasingly popular way to get funds to charities as an alternative to private foundations. And the IRS is working on regulations on donor advised funds. And so things coming down the pipeline include more guidance coming out about how it affects the public support test, and maybe limiting private foundations distribution to donor advised funds. States are starting to see proposed legislation about donor advised funds too, so stay tuned for that. A quick update on this. This is the California new standard about how to classify your workers, and that they created this new test called the ABC test that essentially, in general, roped in a lot of workers that used to be considered independent contractors, and now they're considered employees. Most recently, the California voters passed Proposition 22, which allowed app-based transportation and food delivery companies like Uber and Lyft and DoorDash to be carved out of this test. So they're exempt from this test, which was a big win for them. But there are still other occupations that are covered under this test that may be treated as employees now. So it's important to keep track of this and how it affects your organization. Very quickly, other topics. The IRS released frequently asked questions on contributions or virtual currency on their website. So if this applies to you, it'll be cool to check that out. Hiring credits, for example, the work opportunity tax credits and the empowerment zone credits have been extended through 2020. And then the IRS Form 1089 NEC replaced the 1089 miscellaneous Box 7 form for non-employee compensation for 2020. And then the Mayo Clinic was ruled as a school and therefore was able to exclude their debt financing term from UBI. So this was the 4-year-old legal dispute, and I believe over $11 million were at stake. So this was a big ruling where the courts ruled in favor of Mayo Clinic and against the IRS. Mayo Clinic was the parent organization of several hospitals and clinics, and it also had a college of medicine and science. And so, in that college, in turn, comprised of 5 distinct medical schools and other degrees. So the IRS was trying to say, no, they're not a school, but the courts ruled against them and said, no, they do qualify as a school. The last 2 slides is about group exempt rulings. I'm not going to go into detail too much, but this is another project that the IRS has been working on. So group exempt filings is the concept where a group of organizations are recognized as tax exempt if they are affiliated with a central organization. So this avoids the need for each organization to apply for exempt status individually. A lot of requirements have stayed the same, but there are new requirements. For example, the minimum number of subordinates the central organization must have to obtain group exemption is 5, and to maintain group ruling after that is 1. And with respect to the subordinate organizations, the IRS is now saying that all subordinates need to be described in the same 501c subsection because it makes exercising general supervision and control easier. But if the subordinate organizations are described in 501c3, they all must be classified as public charities under the same paragraph of 509A, but those classified under 509A1 are required to be classified under the same paragraph of 170B1A. So in other words, you can have churches, hospitals, and schools under one exempt ruling. So now Mike will be giving us an update on COVID-19 related news.
Great, thanks, Jane. I appreciate that. We're going to switch gears a little bit from kind of a tax update to a COVID legislation update. Of course, there's going to be tax provisions that we chat about within this section, but overall, this is kind of a checkup on where we've been in regards to COVID legislation and perhaps where we're going to. So let's kind of take a look at where we've been. There's really been 2 large COVID relief legislation packages really pertinent to nonprofits. The first is the Families First Act. That was signed on March 18th, 2020. And this was honestly kind of a smaller act, I think, right as kind of COVID was coming out. It was almost like a little patch, you could say. What the Families First Act did is it expanded the Family and Medical Leave Act and sick leave requirements, essentially mandating that employers with less than 500 employees, they had to provide 2 weeks of sick paid leave, as well as some family medical leave. But then they also did provide payroll tax credits to offset those costs. We'll take a look at those in a little bit more detail right after this slide, and how you might be able to take advantage of those even at year end. And then next, of course, we had the CARES Act that was signed on March 27th. Of course, this was a large relief package, really designed to kind of be the meaty relief package to help those businesses. It did have tax provisions, which impacted businesses, individuals, and trusts, but it also had non-tax provisions such as the PPP loans and the EIDL loans. And we'll take a closer look at some current updates in regards to those as well. Moving forward, we'll chat first about the Families First Coronavirus Response Act, and that was that act signed on March 18th. As I mentioned, this did expand the Family and Medical Leave Act and paid sick leave requirements for employers with 500 or less. So if you had 500 or less employees, you did have to comply with this. The IRS did provide payroll tax credits to offset these costs, though, and these applies for wages paid to employees who needed to take a leave as a result of COVID, beginning on April 1st all the way through the end of this year. So this act actually does sunset at 12/31/2020. So there's not a lot that we can do after this, and currently there's not any extensions that I know of. Although, you know, Congress does kind of work fast in regards to these in some regards. Of course, we've seen they've been dragging their feet into this next big round of COVID legislation. The credit can be used against employers' Social Security taxes, and it can equal 100% of the qualified wages paid. And then any excess credit can be refunded, and you can claim that excess credit on Form 7200. What you can do at year end is, if you have any of these paid sick leave wages that were paid to individuals who did need to take a leave, of course, take a look at your Q2 and Q3 wages. You can always file a 941X to kind of claim these credits. Even if you already have filed your payroll tax reports, certainly take a look to see if this would be pertinent for Q2 and Q3. And then as you're going into Q4 as well, you can certainly claim these credits on the Q4 payroll tax. All right. Taking a little bit closer look at these specific credits. The sick leave credit, this is available for employees who must self-isolate or obtain a diagnosis or comply with a self-isolation recommendation with respect to COVID-19. The qualified sick wages must be paid at 100% of the rate of normal pay, but they are capped at $511 per day for a total of 10 days, so a total of $5,110 in wages. Also, if you need to take time off, or an employee needed to take time off to care for a family member, or there were children whose schools were closed down and they needed to take time off, qualified sick wages are paid at 2/3 of the rate of their normal pay and are capped at $200 per day, totaling for a total of $2,000 in wages. So this is what must be paid as well as the credit that is available as well. All right. I'm going to skip this next slide just because it's a repeat of what we kind of just mentioned. But that brings us to our third polling question. And from here, I'll pass it back to Amy.
All right, thank you, Mike. So our third question is, my organization has taken advantage of either the paid sick leave credit or paid family leave credit. A, yes, B, no, or C, NA. And for those of you that would like a copy of today's slides, you can download them from the folder that says slide deck and handouts. We will also be sending the slides via email tomorrow, along with a recording of the webcast. And we'll leave this up here for another moment. Okay, Mike, here are the results.
All right, well, it looks like a good majority of you have. And of course, if you haven't, certainly take a look at those wages, those sick wages or those leave wages that were paid in Q2, Q3, and Q4 to see if it would be pertinent. All right, Next, we're going to get to the CARES Act, which, as I mentioned, was probably the meatier portion of the relief acts which were enacted. I'm not going to chat about kind of the specifics. I think we've all kind of been hit over the head with the details regarding what a PPP loan is or an EIDL loan. But from a very high perspective, the PPP loan is a loan that there are debt forgiveness provisions. It's available to nonprofits with 500 or fewer employees, or you could meet the SBA size requirements based off your NICS code. But mostly it was available to 500 or fewer employees, those types of organizations. And what the PPP loan was, it was used to cover costs such as payroll, rent, utilities, mortgage interest payments, et cetera. And then, of course, you could apply for debt forgiveness for those various acts as well. There was also the EIDL loan, which isn't as generous because there is no debt provision there, but it did, debt forgiveness there. It did provide for an advance of $10,000, though that did not need to be repaid. And the nice thing with the EIDL loan is it's available to all types of organizations, while the PPP loan was limited just to 501c3s and 501c19s when you're looking at the tax-exempt world. And there's more information regarding the differences regarding these loans. And again, I don't want to hit you over the head with these details because I think we've all received a slew of information about this, especially back in April and May. So I'm not going to go into too much detail on these, but if you'd like to reference the slide on exactly the differences between these two loans, they're here to reference as well. There is the Main Street Lending Program here, which you'll note in column 3. This did become available to nonprofits, I believe, in September of 2020. I haven't seen a ton of nonprofits take advantage of those just because, again, they're not as advantageous as the PPP loans, but it is something that's available as well. What I did want to do is kind of provide an update on the PPP loans and items which might be pertinent to today. One thing I did want to mention is that on June 5th, the PPP Flexibility Act was signed. And what this did is it actually allowed nonprofits, or it essentially, in looking at debt forgiveness, it gave nonprofits who had received the PPP loan prior to June 5th the option on what period they wanted to use to assess debt forgiveness. If you received the PPP loan prior to June 5th, you could either choose the 8-week period to assess debt forgiveness or the 24-week period to assess debt forgiveness. And there's advantages and disadvantages to both, which you can see here on the slide. If you chose the 8-week period, there's, of course, faster forgiveness. The lender has 60 days to review the application, and the SBA has 90 days to confirm. Also, with that 8-week period, it may be easier to meet the full-time employee staffing requirements. And actually, what we saw sometimes was the 8-week period was advantageous because, sadly, some nonprofits did let employees go after the 8-week period. Also, if you did choose the 8-week period, you could take advantage of kind of some ambiguity in the rules and interpretations, which weren't out, which might have come out if you elected the longer 24-week period. Of course, with the 24-week period, it did allow for a greater opportunity to accumulate qualified costs, including payroll, which could be forgiven. So that, of course, I think was the biggest advantageous aspect of that 24-week period, debt forgiveness period. Also, it gave lenders and the SBA more time to streamline the forgiveness application review process. So hopefully, as you're going through your debt forgiveness in regards to the PPP loan, you are seeing that it has become a streamlined process. All right, moving on to some more updates on the PPP loans. The SBA did clarify in regards to the loan certifications and what was whether the certifications were made in good faith. And exactly what loans the SBA would take a closer look at to make sure that that loan good faith certification was made. For loans that were under $2 million, you're automatically presumed that the certification was made in good faith. And the SBA really won't be looking into that loan too much further. If the loan was in excess of $2 million, the SBA likely would still be asking some more questions, and there may be an audit of the funds to ensure that the good faith certification was made. And what this is in regards to, and you might recall back in April and May, there were some questions whether nonprofits and really assessed all capital that they had access to determine if the PPP loan was really necessary. And I know we had a lot of chat with nonprofits as well as other organizations to really determine whether they needed it, because you did have to make that certification. So they did provide this $2 million safe harbor that said, if it was under $2 million, we're really not going to take a closer look at it. We're assuming you made it in good faith. The other big thing to really mention with these PPP loans is that the loan forgiveness is not taxable income, and this is applicable to both for-profits and nonprofit entities. Of course, in the nonprofit world, it's not really applicable because we really only pay tax on unrelated business income. One thing to note, though, is if you are dealing with for-profit subsidiaries or for-profit organizations, expenses associated with obtaining the PPP loan, that is not going to be deductible as an expense on your tax return. All right. Another aspect of the CARES Act, which I'll just briefly mention, is there was the payment of payroll taxes, essentially deferral. And this is for the employer portion of Social Security taxes, which was originally due between March 27th and January 1st, 2021. The amounts deferred do need to be repaid over 2 years. And there was an update from the PPP Flexibility Act. Originally, an employer wasn't eligible if they had debt forgiven under other CARES Act programs, so the PPP loan, but this was updated by the PPP Flexibility Act. This is kind of null and void, but something to consider as we get to year end is you might want to consider the impact on bond requirements or debt covenants, because this is required to be recorded as a liability at year end. So you just want to make sure that you're not tripping up on any of those bond requirements or debt covenants right there. All right, moving on, we're going to jump to the employee retention tax credit. And this is something that was really beneficial to especially nonprofits, which might have been too large for the PPP loan, because there was no size requirement or size limitations like there was with the PPP loan. One thing to note is the employee retention tax credit, it was not available to nonprofits participating in the Paycheck Protection Program. But what it does provide is it provides a refundable payroll tax credit of 50% of the first $10,000 of wages plus health plan expenses, so up to $5,000 per employee, for nonprofits who were, one, either fully or partially suspended due to a COVID-19 shutdown order, which I imagine most businesses have. If you were in an area with a shelter-in-place order, this likely would affect you. Or two, whose gross receipts declined by more than 50% when compared to the same quarter in the prior year. The credits offset your FICA taxes due, and the excess is refundable on Form 7200. So again, we're asking all the nonprofits we work with, take a look at your, if you would be eligible for these, and if so, you can always apply for the credit even in Q2 and Q3 using 941X, the amended payroll tax return. And then as you're looking into Q4 as well, you can always claim the credit on your Q4 payroll tax return. In determining the eligible wages for the employee retention credit, we really need to look at how big you are as an employer. So businesses which had less than 100 employees, the credit was allowed on all eligible wages to employees, regardless of whether they are performing services. However, probably a lot of these businesses might have received the PPP loan, so this might have not been applicable to them because they might have received the PPP loan. With businesses with more than 100 employees, however, the credit is based solely on eligible wages paid to employees who are not providing services due to COVID-19. So these might be individuals who really can't work because of COVID-19 situations. All right. And this brings us to our last polling question, where I'll pass it to Amy.
All right, thank you. So the question is, polling question, my organization has taken advantage of the employee retention tax credit. A, yes, B, no, or C, not applicable. And I'll use this time to let you know that once you have completed all CPE requirements, you will be able to download a PDF of your certificate from the CPE progress window. And also, as a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts window. And here are the results.
All right. Well, it looks like a small amount of you have taken advantage of the ERTC. A large portion of you have it, perhaps because you have received the PPP loan. But if you haven't, you do want to take a look at that. You don't want to leave any money on the table in regards to these provisions. And you can't always do those amended payroll tax returns to claim the credit, even in Q2 and Q3. So something to just remember right there. All right. We're going to move on to some of the other aspects of the CARES Act. And this, I think, will be super pertinent for those nonprofits as we come into year end. And these are the charitable giving incentives, which are available as a result of the CARES Act. And what I tell all nonprofits I work with is, you want to make sure that your development folks are aware of this, as well as your marketing folks, because you want to make sure that all donors know of these incentives, and they are incentivized to give, essentially. The first one is it lists the limitation on charitable contributions of cash by individuals who itemize from 60% of AGI to 100% of AGI. So this is a huge provision, and really you want to reach out to your individual donors to make sure they are aware of this, because this can really decrease their tax liability. For corporations, the limitation is increased from 10% of taxable income to 25% of taxable income. So as you're aware, for corporate returns and even on your 990Ts, your charitable contribution deduction typically is limited to 10% of taxable income. This will be increased to 25% of taxable income. There is some question on whether it will apply to tax-exempt organizations. The code sections that were presented didn't necessarily coincide with the UBI code section. So further guidance might be needed, but we don't anticipate that it wouldn't apply to tax-exempt organizations on your 990T. So we do anticipate that the 25% charitable contribution deduction will be available. We might need some further guidance on that, though. Donations to DAFs and 509(a)(3) supporting organizations would not apply for these increased charitable giving incentives. And lastly, there is a $300 above the line deduction available for taxpayers who don't have itemize in 2020. All right. Moving on, we're going to chat about kind of the net operating loss rules and how they've changed as a result of the CARES Act, excuse me. With the CARES Act, it restored the 5-year annual carryback for losses in any taxable year beginning in 2018, 19, or 2020. As you might remember, the Tax Cuts and Jobs Act signed in 2017, which was effective on 1/1/2018, essentially said any NOLs incurred in 2018 and beyond had to be carried forward, and you can only offset 80% of the taxable income for the year used. And what this does is it changes that rule. And it's even great because let's say you have an NOL incurred in a silo on your Form 990T for just one activity. That NOL from that silo can be carried back to offset any income in 2017 and 16 and 15 if it does fall within that 5-year NOL carryback. So really kind of take a look at your 990T, make sure any losses are declared, that you've analyzed those to make sure that you've taken advantage of all the carrybacks you can, because it can offset all income, even income that wasn't required to be siloed. All right. Lastly, I'm going to chat about the HEROES Act, and this is kind of the where we're going. And I say HEROES Act. HEROES Act might be an outdated term because this was the act specifically that was chatted about in Congress that they were hoping to pass back in October. Any new legislation might not be called the HEROES Act, but HEROES Act. But what we're kind of looking at going forward, hopefully, and these are the potential provisions, is we're looking at maybe greater set-asides for nonprofits. For the PPP loans, these PPP loans might be available to large 501c3 employees, and even if you already received a PPP loan, there might be a second round of a PPP loan possible as well. So that's kind of one aspect which we're looking at, which hopefully Congress acts on in the next few weeks. I know they're trying to pass something by the holiday season. Also, they are looking into the employee retention tax credit and increasing the qualified wages available to claim the credit on. All right. Moving on, we just have 2 more slides before we close out. For any organizations on the call, which are hospitals, notice 2020-56. This did postpone the deadline for hospitals which were required to meet the community health needs assessment rules under 501R. So if you did have to complete a community health needs assessment or implementation strategy, and that was required to be posted on the website by any time between April 1st or anytime April 1st, it was automatically deferred to December 31st, 2020. So if you had an implementation strategy which was due, anytime after April 1st, make sure you get the CHNA and the implementation strategy posted on the website by year end. And lastly, something to just remember is, we're all probably dealing with remote employees who we're not quite sure maybe where they are. You want to make sure you know where your people are because this can have an effect on state withholding obligations for payroll taxes. So really take a good inquiry of your employees, ask them where they are, was the move temporary or permanent, and you want to make sure that you have met your state withholding obligations. We have provided resources here via the AICPA and state tax agencies. So feel free to reference those. Something we did want to mention as we get to year end. I don't think we're going to have time for Q&A, but what we'll do is if you did place a question in the Q&A box, we will get back to you via email. So apologize, we ran out of time, but we will respond to you via email. And with that, I'm going to pass it back to Amy to close out.
All right. Well, thank you, Mike and Jane, for a great presentation today. And if you met all CPE requirements, your certificate is available to download now in the CPE progress window. I will keep the console open for a few minutes to give you time to download. A copy will be emailed within 3 weeks should you have any difficulty downloading it now. And to view a list of all topics in our webcast series, you can click on these links found in your webcast console. And for more resources, please visit our website where you'll find links to our COVID-19 resources, not-for-profit newsletter, and other insights. And here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining our webcast. We hope you'll join us again next time.